So in today's video, I am about to show you an important concept in trading that if you don't understand this, is as same as you are just doing rubbish on the chart. So I am going to tell you about points of interest. They are very important. If you don't understand points of interest and you are still trading, then you are just wasting your time and you are wasting your money. It is better you go and look for something else to do. So I am going to explain all the points of interest that are available in Forex trading. And we have about 6 or 7 points of interest. I will list them out. I will tell you their uses, how you can look out for them when you are trading or when you are managing a trade that you are already in it, or when you are to take your entry and your exit. They are very important. So points of interest are also known as key levels. They are very important. For one, we use them for exit points. When you are in a trade, you will target them as the exit points, because when price approaches there will be a reaction or a reversal of price, so you will target those points as your exit points. You can also use points of interest in Forex trading for your entries. Now, also remember that points of interest are being traded as strategies. You can also use your points of interest for trailing behind a price. So when price is going in your favor, you can trail behind the price using your points of interest as well. So we can see how important they are. So how can you identify your key levels on the chart or your points of interest? So I am going to show you how you can identify them. Now, the first thing that I will want to tell you is that do not check for points of interest on lower time frames, such as 30 minutes, 15 minutes, or 5 minutes, because you will have a lot of noise, or should I say there will be a lot of volatility, up and down movement of the price, that it will confuse you if you are not a pro trader. So if you are a pro trader, you can spot them even on a lower time frame, but you have to shrink your chart the way I am doing. And even at that, you must know market structure very well. But if you go to a higher time frame, it is very easy to spot points of interest, even for a beginner in Forex trading. So I am on the 30 minutes time frame. I am going to shrink my chart to 4 hours. That is where I start checking for my points of interest. So I'm going to the 4 hours time frame. We are in the 4 hours time frame, and you can see how beautiful looking the chart is currently. Now, the first point of interest that I will tell you is a swing low or a swing high. What are swing lows or swing highs? They are points where price originated from, such as this particular low, and then got to another swing point again, a high, and then we have a reversal, and then we have another continuation, then we have another reversal, then we have another continuation, we have another reversal, then we have another continuation, we have another reversal, we have another continuation. All these points that you are seeing here, these high points, high points, high points, they are all swing highs. These other low points, low points, low points, they are all swing lows. They are very important because anytime that price approaches that level, there will be a reaction. And we can see from this chart that anytime that price will clear our previous high, it goes up and retraces back to that same level again. Now that is what some people trade as their support and resistance level. So some people refer to the swing highs and the swing lows as their support and resistance level, because they anticipate that if price has pushed down, they don't expect price to go up and pass this particular high. If price breaks and pass that high that was supposed to have formed a resistance to price, if it fails to form the resistance preventing price from pushing upward, then when it is broken, that same level will automatically support price from falling further. So they call it their support and resistance level. And we can see as price pushed up, it started falling down, and this particular level, which is our swing high here, it turned to a support level to support the price from falling. So price did not fall down again, and it pushed our price upwards. You can see. And when this same zone, or should I say the same level, when it was tested around this same zone, so it's not just a perfect line, it is an area. So when price came down to this particular level, we can see again that price was pushed up, it was supported even the second time again. So a swing low or a swing high is a potential what? Support and resistance level. We can see the same thing happening here. At this level, price broke and passed this level. So this level, this high was supposed to have stopped price from pushing up. However, price broke and passed that, and when price came down, it formed a support for price. So our swing highs or swing lows are also potential points of price being supported or being resisted, depending on if it is buying or selling. If we have known, you can see how important it is. So if you have known it is a potential point, someone that trades support and resistance will wait for the price at this particular level so as to buy to continue the trend. So the next point of interest that I will want to show you again is our Fibonacci levels. You must have been hearing about Fibonacci, but you may not know that Fibonacci is also a point of interest in Forex trading. So I am telling you today it is also what? A point of interest. And like I said, I prefer I go to higher time frames in order to look for my points of interest. So we have Fibonacci levels. So what are Fibonacci levels? I initially said that each of these things are strategies on their own. So if you want to know all about these strategies, I have been making videos about them. You can go through the channel, but as I'm talking about each of them, the videos will appear at the top right hand corner. So if I'm talking about swing lows and swing highs, the video will appear at the top right hand corner. If I'm talking about Fibonacci levels, it will appear at the top right hand corner for you to go and watch and learn how to use each of these points of interest as strategies for Forex trading. So let us go on to Fibonacci levels. Fibonacci, we are going to draw our Fibonacci. So we have swing high, swing low, swing high, swing lows. We can also use them as well for our Fibonacci, because how would you know that this low is supposed to have been created around this particular level if this is where it is starting? How would you know that this low is supposed to have been created around this level? How would you know that this is supposed to have been created here or here? We use Fibonacci levels. And for an uptrend, I will start from the low. I will click my tool and I will extend it to wherever it is. So I will increase it. Let me increase and widen the levels for us to see. So in between this 50 and 61%, it is known as our golden zone, and price will what? Reverse around that particular level. So many traders will wait for price to fall into this. Now there is not a must that price must fall here, but most times price comes back into this particular level. Sometimes it can return at the 23% or 38%. It can return at 50, it can return at 61, it can return at 78%. But what we are noting here is in most cases, you will see it is between the 50 and 61% retracement level. And that is why they call that zone as the golden zone in Forex trading. And we notice that as price came back inside, it is truly at the golden zone that price reversed and pushed up. I will advise you to go and watch more about my Fibonacci retracement strategy. The video will pop up at the top right hand corner right now. So having known that, let me delete this and draw another level. So price retrace back at this level. From this swing low again, we are still going upwards. So I am going to pick my Fibonacci tool again. I will draw from this swing low where price got to this swing high again. I will extend it. Let's see what level is going to give us. You can see that between the 50 and 61% level, that is where price is retracing from again. So that is why I'm telling you that the Fibonacci levels are also points of interest, because some people are interested in that particular level anytime they are trading. That is their own strategy. So it is also a potential point of entry for you. When you enter here, you are targeting the next high because you are following a trend. So you are anticipating here. So you enter here and you exit at this level, or you can hold it if you believe that the trend will continue. That is the second point of interest. So let us go to the third point of interest. The third point of interest that we are going to look out for right now is our trend line. And there is a way that you will draw your trend line correctly. If you don't know how to use trend lines or how to draw them, a video will also pop up at the top right hand corner. You can go and watch it right now. So for a trend line, you need swing points as well, but you are going to be connecting it. You need two swing points to be formed. So we will have one point here, we can have another point here, and we will anticipate the third point. That is how you go about with trend lines. So when you see the first point is formed, the second point is formed, and then you will wait for the third point. Anytime that price touches the line again, it is a point of interest for those that trade trend lines. So we can see after the second point was formed here, we have another touch here. We also have another touch here. You can see it. So price kept bouncing on it until it was finally broken below. And if it is broken, it forms a resistance again to push price to go up. So a trend line is also a point of interest, but then is the touch on the trend line starting from the third touch. That is what we are interested in. And also when it is broken, we will anticipate a retest of that trend line. So the level at which it is retesting, we are also interested in that particular level. And that is what some people also trade as a trend line break and retest, or a third touch on your trend line, or a fourth touch on your trend line. And we can see how each of these points are also points of interest, because if this is the second, when price pushes down, by the time it's approaching this trend line, this point where it's touching it becomes your point of interest. When it's touching it the fourth time, it becomes your point of interest. And this type of thing, sometimes a trend line can keep pushing price even 4 times, 5 times, 6 times. You will never know when it will break it. But when it is broken, it is automatically turning to a support level as well. So we have our trend line. you can go watch the video as I have told you initially. So our fourth point of interest are fair value gaps. If you don't know what fair value gaps are, I have made a very lovely video that I took my time to tell you how to trade fair value gaps profitably so that you can make profits in the market. So I am just going to point them out here because they are very useful. When price comes to fair value gaps, there will be a reaction. So I am going to a higher time frame, to the weekly time frame, to show you how fair value gaps occur. They are very lovely on higher time frames. So we are in the weekly time frame here. We have it clearly here so that you can see the power of fair value gaps. For fair value gaps, we are looking for three consecutive candles occurring together, but then the first candle and the third candle, there should be a gap that exists between the high and their lows, such as this bearish, this bullish, and this bearish. Now, whether it's bearish or bullish doesn't matter. The important thing is that we need three candles that are consecutive. And the first candle and the last candle, the third one, there should be a gap that exists between them. So this week of this one that we are considering, you can see there is a gap here. And then we have the week of this particular one, this doji that is here. There should be a gap. So a gap exists between this candle and this third one. This one in the middle is not considered. This gap is known as a fair value gap. Anytime the price forms this and starts to retrace and go into it again, it has the capability of a possible reversal of the price. So instead of price to continue and pass through it, price will fall down. That is the power of a fair value gap. It is very important. So if you were in a buy on a lower time frame, because this is a weekly time frame, this is a very significant movement from this level to this level, you will catch a lot of pips. So don't underrate this tiny movement that you are seeing on a higher time frame to this level. If you are in a buy and it's approaching this particular fair value gaps, you have to exit at that particular fair value gap. Or for some people, they'll wait for price to enter into the fair value gap and then they will look for a sell to sell down. I have explained how you can look for a sell or a buy in a fair value gap. I have explained it in the video. So go and click on that fair value gap video and watch it. So fair value gaps are potential points of interest as well. People set their eyes on points of interest such as the fair value gaps. If you're a beginner, you may not know about any of these things and you think price just moves for just moving sake. No, we can see the same thing happening here. There is a gap between this bearish candle and this other bearish candle again. If we are to draw it, we will see this is the end of the bearish. So I'm going to take my box there and now extend it to the top of this other bearish, and we'll see that there is a point there. When I draw it, you see that even though price pushed up, it came down inside the fair value gap and was reversed to the top side again. So a fair value gap on a higher time frame is very significant. It's a point of interest, a key level that you need to watch out for when you are trading. So our fifth point of interest that we will be looking for are the order blocks. And what are order blocks? They are closely related to fair value gaps because some people use the two together, those that trade smart money concept. They are very significant as well. An order block occurs when you see that price is pushing to one side, then we have something like price tries to melt back again. However, the buyers push it and close above that bearish candle that was formed. Okay, So when you see that a bearish candle form and then you have long candles in the opposite direction, is telling you that there is a significant push that move with speed beyond the sellers that were trying to sell the market. This type of candle is what you refer to as an order block. So from the top of that candle to the last low of the candle is a significant point of reversal of price. So price is likely to reverse whenever price comes back to that, and you are looking for such points. They are mostly located around swing points, such as a swing low like this or a swing high such as this. So like for this one, it is the last bullish candle that created the move that price started pushing down. So we will look for that. This is our candle, the bullish candle that created that move that pushed price downward. We are going to draw it like this. Anytime price enters into it, you see price pushes down. This is an order block as well. For this, we are looking for a bearish candle that caused a push up. So someone can take this, another could take this last candle that caused a push. So this is the last candle with a wick. Some could take that as their order blocks, this doji that you are seeing here. So they could take that as their order block. And anytime the price enters into it, you can see how it pushed price upwards again. That is the power of order blocks. It is also a significant point of interest. So to me, I see order blocks as something that are closely related to demand and supply zones, because if there is great demand for price, those that trade demand and supply will tell you anytime price enters into their previous point where it was resisted, so price pushed down to this level and then it moved up, then anytime they see price approaching this previous low again, they will say there's a great demand for it. They will watch out for how price will react to here, and then they will enter to buy the price upward again. So those trading order blocks and demand and supply, they do virtually the same thing. Okay, so some can call this zone that you are seeing as a demand zone because price is rejecting this particular level. The only difference with the order block is that an order block is not necessary that it must occur at a particular low. Like I told you, you can see it in between. You can see as price is pushing upwards here, this is another order block that is formed. This bearish candle that you are seeing. So those that trade order block can now use this bearish candle. Let me just delete it and draw a new one. So this bearish candle, from this bearish candle that was formed, you can see price pushed up with speed. So they can draw a box at the top to the low of that candle, and they will wait for price to tap into their order block. So you see why I told you that order blocks and fair value gaps are often occurring together, and some people trade them together. So this is a fair value gap around here. Those that trade fair value gap will take the entry. Those that take order blocks, they expect price to tap into their order block, they take it as well. So the only difference is that order blocks is not necessary that they occur at the lows. It's not necessary. They can occur as price is pushing up. It can be creating order blocks, but most times you see them at your previous swing points of swing highs. And those that trade demand and supply may also say there's a rejection of price here, so they will take their entries. That is the fifth type of point of interest that I want to tell you. And the last one is the demand and supply, of which I have discussed it already. Remember, if you want to watch more about order blocks, I have also made a video. It should pop up at the top right hand corner. So for the demand and supply, I have explained it, but I will just go over it. So let me go down to the 4 hours to explain demand and supply for you. So for demand and supply, we are looking for a zone. Remember, it's not a perfect line that you will say, oh, it has to be so perfect. No, it is more of an area. So it's not just a straight line where price tap into it and then we saw a reaction, price pushed in the direction it wants to go to. So you are going to take note of that and you wait for price to see what it would do at that level the second time. Price entered into the level, we saw a reaction, price pushed up again. So people that trade this will now extend the line again and wait for price the third time and they take their entry and they will buy. And as they are buying, they are also looking out for other points of interest that you are seeing. So they can be targeting this high, but sometimes price will go up as high as this, sometimes it will not, it will fail. However, they should have made some amount of profit that is more than 1 to 2 or 1 to 3 before price will think of reversing. You can see it. So this is a demand zone because as price reaches here, there is a great demand for this asset at this level. A lot of buyers will come in and they will push the price further up. For supply, is just the opposite of demand, where if price reaches a certain level such as this, price is pushed downward. So when price reaches this level, we can see it was pushed down. It reached here the second time, it was pushed down again. It got here the third time, it was pushed down again. So this is a supply zone because there is a great availability of this asset. Anytime it enters, it's sold down. Anytime it enters, it is sold down. That is what a supply zone is all about. And it is also a point of interest. So having known our 6 points of interest and I have explained their importance for you and how they are used as trading strategies, there are videos about them I've advised you to go and watch. It should give you a better understanding of why price is reversing at a certain level. Price doesn't just reverse, it reverses as a result of these points of interest. So anytime price goes towards that place and you are in a buy or a sell and is approaching any of these, be careful because price can reverse at that level. And also people trade them because they use them as points of reversals or entries. So it depends on whatever you want to use them for. If you have any question regarding points of interest or key levels that are used for forex trading, just let me know in the comment section. So do have a wonderful day. Bye.